Hi, morning everyone. We're just waiting for a few more people to join the webinar, and we'll start in a couple of minutes. Thank you. Hi, morning everyone. We're just waiting for a couple of minutes, and we'll start off. Good morning, everyone, and welcome to our webinar on the cessation of Libor and the transition work that is undergoing on this matter. So with all these deadlines looming, we have a deadline coming up for the end of the year on US dollar Libor, and another deadline actually coming up much sooner at the end of this month, the 31st of March, for GBP. I think there's a lot of work that's been going on by financial institutions around the region. And what we're going to do today is to cover some of the approaches that are being adopted in the US and the UK, specifically covering what the Loan Markets Association is doing, what ARC is doing in the US, what the recommendations are from ISDA. So we'll definitely be covering these three bodies. We, on our part, have been actively assisting clients, especially in Saudi Arabia, in the UAE, and Kuwait, on this transition work, and we can see that it's really gathering steam now at the moment. So Madhurima, if you can just take me to the agenda slides, I'll just quickly walk everyone through what we'll be covering today. So we'll be covering, this just the sort of background in terms of what's happened on Libor cessation, some of the recent updates that have happened since then, and then the approaches in terms of Libor transition for loans. And the view on derivatives, on the derivatives side, that have been suggested by ISDA. We will have a Q&A at the end of it, but please feel free to add in your comments in the chat box as we go along. And we can answer those questions either while we go along, or we may send you something later on after the session is over. There's a lot of literature out there, and we can probably point you in the right direction in terms of your question. So just to introduce the team today. My name is Rafiq Jaffer. I'm a partner in the banking team at Ultimimi, and I head the banking team in Bahrain. My colleague, Madhurima Basu, is a derivatives lawyer, and she will be going through the derivatives section of this presentation. Ahmad is a debt finance lawyer, and he'll be talking more on the loan side. Natalia is based in our Bahrain office, and I think does a bit of both on the derivatives and lending side. So yeah, with that, I'm going to hand over to Madhurima to start the presentation. Thank you.
Thank you, Rafiq. Good morning, everybody. Libor is the single most important benchmark underpinning trillions and trillions worth of contracts. It's there in various currencies, so it's not only the US dollar that is being impacted. Now, the Libor cessation journey started in 2017, but the issues were there even before that. There were some cracks that were seen sometime during the crisis, the global financial crisis, but it's essentially after that, when the Libor scandal happened, that the credibility of Libor was severely eroded. As you may recall, many of the global FIs, the likes of Deutsche, JPM, etc., they were involved in colluding to manipulate Libor submissions. And this led to a wave of lawsuits, fines, regulatory actions against them in various countries. Around this time, if you remember, it was the Financial Services Authority in those days, the FSA. Martin Wheatley, who led the FSA in those days, investigated all of this and came up with the Wheatley report in September of 2012. He asked for comprehensive reforms of the Libor submission process and the Libor rate, but not replacement. He had a lot of, he included a lot of recommendations on how exactly to do that, but some of them included the stricter processes to verify the submission of Libor. And he also suggested that market participants should have a role in overseeing the Libor process. In fact, as a result of his recommendations, in 2014, the administrator of Libor was changed from the British Bankers Association to the ICE Benchmark Administration. At the same time, around in 2023, IOSCO launched a public consultation on how to improve the Libor, and there was a review and implementation of IBOR's principles, IOSCO's principles for financial benchmarks around that time. Now, fast forwarding to 2017. Now, it came suddenly out of the blue, but Andrew Bailey of the then reformed Financial Conduct Authority, or the FCA, announced that FCA would no longer require panel banks to submit Libor rates post 2021. And in the next year, in 2018, FCA announced that markets needed to end reliance on Libor post 2021. Now, this is a very, very different ask because of the importance of Libor in the market. So this was an impetus for industry groups and regulators to start market consultations on which rate should be the successor to Libor. Most of these reform groups were set up, so ARC in the US, as well as the Sterling Working Committee in UK. But other than that, even industry groups like ISDA and LSTR set up their own working groups. Now, coming to what rates are actually replacing Libor. So the most common one that we all know about, I'm sure, is US dollar rate, which is now moving to the SOFR, or the secured overnight funding rate. The GBP is moving to a reformed SONIA. So it's a reformed sterling overnight index. The JPY yen Libor to the TONA, or the Tokyo overnight average rate, CHF to SERON, and euro to the euro short-term rate. The key point here is they are all currently being administered by their regulators, which is the Reserve Bank or the Swiss exchange in case of SERON. Most of these rates are being published since 2018, but given the guidance from the various regulators, it is now seeing a lot of depth in transactions. So it is going to be providing liquidity to the market. Now, fast forwarding to 2021, so Libor cessation work has been ongoing for some time. The COVID pandemic set in, so there was some expectation that maybe the timelines would be delayed. But a little over 2 weeks ago, on the 5th of March, 2021, the FCA came out with its announcement, and it announced the dates on when all Libor settings will cease. It is the 31st of December for all sterling, euro, Swiss, and Japanese yen settings and certain US dollar settings, and the 30th of June 2023 for the remaining US dollar settings. It also announced that the FCA does not expect any LIBOR settings to become unrepresentative before these dates. Now, what this means for the various products, we will go into when we discuss the products. And finally, it announced that it will consult whether a continued publication of certain tenors and rates on a synthetic basis is required after these dates, only for tough legacy contracts, not new contracts. At the same time, the Federal Reserve of the US also sent a letter to the institutions under its supervision on the 9th of March, and it said that they should be making progress in transitioning away from LIBOR by the 31st of December 2021. It included guidance for assessing efforts for larger and smaller firms. And that is key because the systemic risk posed by smaller and larger firms are not the same. So the efforts should be treated differently. But crucially, it said that the LIBOR-based contracts entered into before the 31st of December by these entities should have robust fallback language that includes a clearly defined alternative reference rate. And I think we can now move on to the next section. Natalia, do we have any questions that we should be addressing now?
No, not at this stage.
Perfect. Then I'll hand over to Ahmad, who is going to take us over the issues for the loan side.
Thank you, Madhurima, and good morning, everyone. So there are various working groups working on the LIBOR transition. In this webinar, I will be focusing on the Alternate Reference Rates Committee and the working group on Sterling risk-free reference rates. So the Alternate Reference Rates Committee, or ARC, is a group of private market participants convened by the Federal Reserve Board and the New York Fed in 2014 to help ensure a successful transition from US dollar LIBOR to a more robust reference rate is recommended alternative, the SOFR. The ARC is comprised of a diverse set of private entities that have an important presence in markets affected by USD LIBOR, and a wide array of official sector entities, including banking and financial sector regulators as ex officio members. Now, importantly, ARC has published a paced transition plan where specific steps and timelines have been designated to encourage adoption of SOFR and applicable on US banks. They have published a comprehensive user guide and a number of product-based conventions which set out a range of ways in which SOFR could be used in those products. And lastly, ARC has also published detailed product-based fallback language for new issuance of cash products that continue to reference USD LIBOR. Some of the products for which ARC has published fallback language includes floating rate notes, syndicated and bilateral business loans, securitizations, and adjustable rate mortgages. Now moving on to the working group on sterling risk-free reference rates, like ARC, it is also formed of a diverse group of market participants and trade associations representing relevant sectors and markets. The Bank of England and the Financial Conduct Authority participate as ex officio members of this group. The overall objective of the Sterling RFR working group is to enable a broad-based transition from LIBOR to SONIA by end of 2021 across the sterling bond, loan, and derivatives market. The Sterling RFR working group has also published a number of conventions, which includes detailed SONIA calculation methodologies, recommendations, guidance, and timelines to support new loans referencing SONIA and the transition of legacy GBP LIBOR loans to SONIA. Importantly, it has published a document titled Priorities and Roadmap for Transition by End 2021, which contains the recommended milestones. The two key recommended milestones for 2021 related to GBP loans applicable on UK banks are by the end of Q1 to cease initiation of GBP LIBOR linked loans that expire after the end of 2021, and by end of Q3, complete active conversion of all legacy GBP LIBOR contracts expiring after end 2021. The Sterling Working Group has also published a best practice guide to support market participants in LIBOR transition and to meet the working group's recommended milestones. The best practice guide consolidates all relevant information from the previous working group publications to provide a single point of reference for best practices and includes detailed conventions for new GBP Sonia loans, including refinancing and renewals, and for transition of legacy GBP LIBOR loans. Madhurima, can we please move to the next slide? Thank you. So now coming back to the various approaches in the market, I will start off by speaking about the fallbacks which have been recommended by ARC. As I previously mentioned, ARC has published a number of product-based fallback languages. In this webinar, we will take up ARC's recommended fallback language for new originations of LIBOR bilateral loans, which was published on 27th August 2020. So the ARC recommended fallback provides for a hardwired approach. This approach essentially can be used in transactions which contemplate USD LIBOR loans at the onset with a switch to SOFR base rate. Essentially, the hardwired approach contemplates the inclusion of a pre-agreed conversion terms in loan documentation. This would involve inclusion of a switch mechanism into the loan documentation, which would provide for the initial benchmark rate, which could be based on LIBOR or any other term, forward-looking term rate, to be automatically converted to an alternative SOFR on pre-agreed terms set out in the loan documentation on the occurrence of a specified trigger event. And I'll go through these terms in more detail now. So the fallback language provides essentially for 4 triggers, and they define it as the benchmark transition event. The first 2 triggers are categorized as permanent cessation triggers. They require a public statement or publication of information that the actual cessation of LIBOR has occurred or is expected by the administrator of LIBOR or any regulatory supervisor of the administrator of LIBOR or the central bank for the currency of LIBOR, in this case, the US Federal Reserve System, or a bankruptcy resolution official or court with jurisdiction over the administrator of LIBOR. The third trigger, which is categorized as the pre-cessation trigger, requires a public statement or publication of information by the regulatory supervisor for the administrator of LIBOR, announcing that applicable tenor of LIBOR is no longer representative. Now, the last trigger is a early opt-in trigger, which provides that even if LIBOR is still being published, the lender can make an early opt-in election, which will then lead to a benchmark replacement event. Now, in order for the lender to make this election, the lender first has to make a determination that a set number of currently outstanding US dollar denominated syndicated or bilateral loans at such time contain a SOFR base rate in the market. So these were the benchmark transition events. As soon as a benchmark transition event occurs on a specified benchmark replacement date, which I will also discuss, LIBOR in these transaction documentation will be automatically replaced with the benchmark replacement rate. The fallback language contemplates the benchmark replacement rate to be determined through a waterfall mechanism. So it starts off with a forward-looking term SOFR, which is recommended by the relevant government body, and adds in a credit adjustment spread to this. The second waterfall is a daily simple backward-looking SOFR plus a credit adjustment spread. And finally, it's the lender selected rate plus credit adjustment spread. So if the first limb is not available, you go to the second, and if that's not available, you go to the third limb. The benchmark credit adjustment is also defined within the hard-wired approach, and it is also determined through a waterfall mechanism. So the waterfall starts off with the ARC selected adjustment, then it moves on to the ISDA fallback adjustment, and then it moves on to the lender selected adjustment. Just very briefly in terms of the spread adjustment, what ARC has recommended that it is going to be using the spread adjustments for non-consumer cash products, which are the same as the ISDA spread adjustment for USD LIBOR. For consumer loans, for loan products, it is going to provide a transitionary period of 1 year. Now, lastly, and a very important point to note is that ARC in a recent announcement has confirmed that due to the FCA and ICE's announcement of 5th March 2021, the benchmark trigger event, which I previously mentioned, has occurred. Now, the occurrence of this benchmark transition event does not, however, require an immediate transition under the ARC recommended fallback language. This is because the actual transition happens upon the benchmark replacement date. In this case, the benchmark replacement date will occur for 1 week and 2 month USD LIBOR by 31st December 2021. And for overnight 1 month, 3 months, 6 month, and 12-month USD LIBOR on June 30th, 2023. So this remains as a viable option for market participants to include in the transaction documents, which initially contemplate is forward-looking term rate, which automatically switches to SOFR. And just to conclude, the ARC side, they have a number of other recommended languages as well based on the product description. So the one I just presented was for bilateral loans. They have separate language which is mirrored on bilateral loans. For syndicated loans, then they have for securitizations, adjustable mortgages, etc. Moving on to the LMA approach now. The Loan Market Association has published several documents containing various approaches to assist market participants when including active transition mechanisms in the loan documentation for LIBOR transition. After the ICE and FCA's announcement of 5th March, there are essentially 3 LMA-based approaches which can be considered, and I will be discussing those. An important point to note, though, is that the LMA approaches are set out in various exposure drafts issued by the LMA. Therefore, it is not as yet in their approved form. It is being issued to the market for raising awareness, for consultation purposes, and just to educate people on how to structure loans under these 3 approaches. So the first approach I will discuss is the rate switch approach. The rate switch approach is included in the LMA exposure draft of multi-currency term and revolving facilities agreement incorporating rate switch provisions, which was updated on 23rd November 2020. Although the rate switch exposure draft comprises multi-currency term and revolving facilities, the Sterling RFR working conventions apply to SONIA loan market. These conventions have been applied throughout the exposure drafts, including to other currencies for which the terms are set out. This has been done for reasons of simplicity and for potential operational ease, and therefore it is open and it is the responsibility of each market participant to determine their view on whether those Sterling RFR working group conventions are suitable for their transactions in respect of referencing RFRs other than SONIA. Now, the rate switch approach is similar to the hardwired approach recommended by ARC in that it contemplates the inclusion of pre-agreed conversion terms and a switch mechanism. The key features of a rate switch approach are initially the interest is determined by reference to an existing forward-looking term rate, for example, LIBOR. On the occurrence of a rate switch date, which I will also talk about, the interest rate will switch to the agreed alternative RFR calculated on a compounded basis. This, for example, could be the compounded SONIA for sterling loans, and the loan will convert into a compounded rate loan. The calculation for interest for compounded rate loans in the rate switch exposure draft is based on daily non-cumulative compounded RFR rate to which a credit adjustment is added. This method is recommended by the Sterling RFR Working Group Conventions, and detailed calculation methodology and the formula to be applied to calculate the compounded rate is set out in the respective schedules of the rate switch exposure drafts. The compounded rate, just to give you a brief flavor on this, is essentially determined using the formula over a look back period, which is typically set for 5 days in the observation period rather than the interest period. Now, this is important to note since in LIBOR-based loans, uh, interest is fixed at the beginning of the interest period. So all parties then know how much interest the borrower will have to pay at the end of the interest period. By contrast, given the nature of RFRs, them being backward looking, the total interest accruing over a period based on a compounded RFR cannot be determined until the end of that period. Therefore, a look-back mechanism provides that the interest period payable over an interest period is not determined by the RFR over the interest period itself, but rather over an observation period. The observation period is the same number of business days as the interest period, but it starts and ends a specified number of business days before the relevant interest period. As a matter of example, if your interest period is 1st April, the observation period, if you have a look back period of 5 days, will start 5 days before 1st April and end 5 days before the end of April. During this period, the interest will be, the RFR rate will be calculated and notified to the borrower so that at the end of the interest period, the borrower knows how much interest it has to pay. In relation to the credit adjustment spread, um, so there are two options. You have to specify a methodology or a formula which will produce a percentage rate per annum, or you can include a specified hard percentage per annum in the loan documentation. It is left to the parties to determine how they will figure out their credit adjustment spread. The rate switch date in the rate switch exposure draft is a pre-agreed backstop date, which will be set out in the loan agreement, or it will be a date following a rate switch trigger event. So it could be, for example, a date you specify as 30th November, or it could be a date immediately occurring after a rate switch trigger event has occurred. Now I'll talk about what the rate switch trigger events are. So the rate switch trigger events are similar to the cessation and pre-cessation trigger events, which were proposed by ARC, which I previously discussed. However, it does not include the early opt-in election proposed by ARC. The definition of rate switch trigger events, however, does include an option for the parties to agree to additional trigger events, which they can include. And in one of the supplementals, ARC, LMA has recommended that parties can choose an early opt-in election as well. The rate switch approach is therefore appropriate where parties have been able to agree to all terms relating to the conversion prior to entering into the loan documentation. Important point on this one is as well is that in view of the FCA notification of 5th March, the rate switch trigger event has occurred. Nevertheless, the rate switch approach remains a viable option because the rate switch trigger date will be either the backstop date or for GBP LIBOR end of 2021. The second approach is basically to enter into facility documentation which are based on an RFR rate from the onset. This approach is set out in the LMA published exposure drafts for multi-currency compounded rate and term rate facilities, which was updated on 28th January 2021 and includes the proposed language for USD, Sterling, Swiss franc, and Euro loans, which are linked with SOFR, SONIA, SARON, or Euro short-term rate from the onset. The calculation of interest for compounded rate loans in any currency under the RFR exposure draft works the same way as in the rate switch approach for a compounded rate loan. That is, it is based on a daily non-cumulative compounded RFR to which a credit adjustment is added. The RFR exposure drafts include, similar to the rate switch draft, a detailed calculation methodology and the formula to be applied to calculate the daily non-cumulative compounded RFR. Now, same as the case with the rate switch exposure drafts, the RFR exposure drafts also comprises of multi-currency facilities, and the Sterling RFR working group conventions have been applied throughout. So the market participants have to determine how applicable they are to them. One point to note, though, is that in the definition, in addition to the RFR-based loan facilities, the RFR exposure draft also contemplates and includes rate switch provisions for term rate facilities from the onset. So the draft cannot be used, of course, as is. If you're seeking to only enter into a RFR-based facility from the onset, you will have to only choose the appropriate language and then incorporate that within your loan documentation. LMA is working on other forms of exposure drafts where they could have different options for the parties to select. But right now, this is the only exposure. These are the only exposure drafts which talk about the rate switch, and they talk about the RFR facilities from the onset. There is, however, a third approach as well. This approach is helpful where the parties are unable as yet to enter into, well, the parties have not entered into the facility documentation based on RFR or have agreed to any pre-conversion terms, but they intend to amend the documentation to include terms for replacement of Libor prior to cessation. So essentially what this document looks like is it would be your standard Libor-based transaction document. The LMA in its supplement to the revised replacement of screen dead clause rider has included a approach called the agreed process for renegotiation. What this mechanism does is that it provides the lender and the borrower to set a date. And this date should be set, of course, much ahead of the end of, sufficiently ahead of the end of 2021. And by this date, the lender and the borrower have to agree in good faith the use of a replacement benchmark, and such negotiations have to be completed by this the set out date in the loan documentation. The LMA language also provides for flexibility to include any pre-agreed high-level terms of the conversion that you have agreed. Now, as is obvious, this agreed process of renegotiation is obviously not the preferred method, as it does not provide any certainty to the lender or the borrower what the conversion terms would be. And it only contemplates that at a future date, the parties will agree to, will enter into negotiations and agree to the pre-conversion terms. Further, once the parties have agreed to pre-conversion terms, the agreed process of renegotiation approach requires the loan documentation to be amended at that time to incorporate that approach. Although not a preferred method, but it remains a viable option in case the market participants have not agreed to pre-conversion terms or are not in a position right now to enter into RFR facilities from the onset. So this was just a brief overview of what the ARC is doing and what the LMA is doing. Interestingly enough, just 2 days ago, on the 22nd of March, the Islamic, in relation to Islamic finance, the International Islamic Financial Market has come out with a white paper on global market trade reforms and implication of IBOR transition for Islamic finance. The white paper is a very interesting read, and it includes contributions from a number of participating institutions, including EY Bahrain, Standard Chartered, Darul Sharia, and it covers a range of topics, including the recent developments on Libor transition and various approaches by working groups, some of which we have presented in this webinar, and my colleague Madhurima would. And it also covers contributions by E&Y highlighting the potential accounting and reporting issues arising in general on Sharia compliant contracts from RFR transition. Now, this white paper is issued to create better awareness in the Islamic industry and will be used as a basis in the development work to be undertaken by IIFM, in particular on the Libor transition, including development of benchmark fallbacks and transition language for Islamic finance contracts in new and legacy contracts. This is a space we will definitely be watching and will keep you updated on. Madhurima, can we move to the next slide, please? So now in terms of next steps, given the fast approaching deadline of 31st December 2021, we encourage all financial institutions and relevant marketplace to carry out a assessment of their legacy LIBOR loan documentation and their template loan documentation to be transition ready. This is where we can assist you. For legacy transactions and your loan documentation, we can undertake a gap analysis to assess if the documentation contains robust fallback provisions, and we're not in assist in repapering that documentation in line with the various approaches which are prescribed by ARC or LMA as per your requirements. Thank you for listening. I will now hand over to Madhurima to continue with the presentation.
Just before we move on, Ahmad, we've got a question.
Sure.
So we've got a question from Mustafa Barwan from Gulf International Bank. And his question is, how are borrowers going to react to the RFR being determined in arrears as opposed to the determination of LIBOR in advance? And how's this going to affect the Islamic Murabaha facilities?
Yeah, that's a very good question. And actually, this is something which a number of banks we are aware of are actively thinking about. So the work stream which they have divided amongst themselves is obviously how they go about the transition process in terms of the LIBOR transition. But added to that, a very important factor is what is the communication channel to the customer? What is the message which will be presented to the customer? How this entire transition will be presented to the customer? That in itself is a very, very important role for a bank, especially in framing and saying in basic words how this entire process will impact a borrower per se. From a borrower perspective, of course, this is something new. This is something they will have to be educated upon. But given that the entire market is shifting towards a backward-looking RFR, it is something which the borrowers will have to get used to. One thing of a very important note is that in addition to backward looking RFRs, there is also talk about introducing forward looking RFRs. That itself in its infancy stages right now, but that is also a viable option which comes about later on. Your second question in terms of how this impacts the Islamic Murahaba contracts, again, like I mentioned, this is something which is being actively worked on by the International Islamic Financial Market. And the white paper has been issued, which specifically recognizes that work needs to be done on the Islamic front. It specifically recognizes that there may be a need for a Islamic RFR. There is a need for restructuring Islamic Muraba contracts. In the white paper, if you go through that, you will note there are a number of alternate structures which have been presented by SCB, which are presented by Darul Sharia. Some alternate structures are based on the concept of reverse Muraba. For example, they contemplate, some Muraba structures contemplate the Lma approaches. But right now, there is no uniform, consistent market approach to go about it. The good thing, though, is that IFM has taken this upon itself to develop a framework which will be a standardized framework for all Islamic finance transactions, including Muraba, Ijara, etc. And of course, as soon as we have any updates on this, we will definitely share those with you.
Thank you, Ahmad. Just touching on the question on what the impact on the borrower, the one thing that can present an opportunity for the banks is actually more hedging. It's going to be very late in the day that the banks actually, the borrower understands what it needs to pay, and it might want to have that certainty in advance. And this might prompt them to get more of fixed to floating swap, which it wouldn't have contemplated before just because of timing. So if you're out there, it's definitely an excellent opportunity to get more hedging onto your books. Now, Coming on to the view on the derivative side, when Libor cessation was first confirmed in the market, ISDA set up its IBOR working group to consider the IBOR issues for the legacy transactions and the new transactions. We'll discuss their recommendations in a lot more detail in the next few slides, but basically their recommendations come in the form of a protocol, some bilateral amendments, and a supplement to the 2006 ISDA protocol. And in the next few slides, we'll also be discussing what are the limitations of the protocol and how that impacts market participants and what you need to do, particularly for a cash instrument linked hedging and the Sharia compliant derivatives. And also we'll consider the impact of the recent announcement by the FCA on the derivatives products. So to start off, what exactly is a protocol? A protocol is a multilateral way of amending documents. This is definitely not ISDA's first protocol. ISDA usually comes up with a protocol every time there is a market-wide change, whether it's a commercial change or a regulatory change. And so it has come up with various protocols over the years. This particular protocol, of course, affects a wider range of audience, so it is more popular than the other ones. This protocol, the ISDA 2020 IBOR fallbacks protocol, was published on 23rd October 2020, and it became effective on 25th January 2021. That's the effective date. It amends and restates the fallback language for various IBORs. Currently, it's only the Libor settings that are being replaced, but ISDA has actually taken this opportunity to restate the fallbacks for certain other IBORs as well, which could be used which could be replaced in the next few years, particularly say the BBSW, which is the Australian benchmark, the CDOR for Canada, the Hong Kong interbank offered rate, the SOR, which is a swap overnight rate in Singapore, and the Thai interest fixing rate. Particularly for SOR and THP fix, these are synthetic rates, and its administrators actually use the USD Libor as an input to come up with these rates every day. So this is also directly affected by the change in the Libor, and after the relevant dates, the administrators will be using the software to come up with the SOR and the THP fix. Now, how exactly are these amendments working? Which documents are being impacted and affected? So the ISDA has included all of its ISDA master agreements as a part of the protocol covered agreements. That includes the 92 and the 2002 version for the English and the New York law documents, but also its other versions like the Irish law document as well as the French law documents. It includes all of ISDA's credit support document, which are the credit support deeds and the annexes, both across variation margin and initial margin. It includes all transaction confirmations, which are in the ISDA way. But other than that, because the participants are very similar for some other documents as well, which are namely the GMRAs and the GMSLAs, ISDA has included these other documents in the list of the protocol covered agreements. Unfortunately, or the reason why we'll cover in the next few slides, is the Tahawut agreement is not one of these additional documents that is covered in the ISDA protocol. Now, how exactly are the legacy contracts being amended? So the legacy contracts have to be in one of these protocol covered agreements, which are the master agreements, credit support annexes, confirmations, or additional documents. And it needs to incorporate an ISDA definitions booklet or should reference the relevant IBOR. Now, the most obvious definition booklet that is being amended is the 2006 ISDA definitions, which is the one that included the fallbacks for all of these rates. But ISDA has taken a very holistic view on this, and it goes back to amend the 2000 ISDA definitions, as well as the previous iterations, the 91, 98, etc. From the market participants in Bahrain, I would expect most of your trades to be governed by the 2006 ISDA definitions, but for some long dated trades, you could have 2000 ISDA definitions as well. But even if you have certain old definitions, all of those are covered by the protocol. Now, if you've already signed up to the protocol, you know how exactly this works. But for those of you who haven't done it yet, adherence can be done directly on ISDA's website. You have to pay a one-time cost of $500. And once you fill up the form, ISDA will send you back an email to say that your adherence has been affected. And that's when from your perspective, the adherence is done. There is currently no cutoff date for the adherence. So there is still time to do it if you haven't done it. As I said, this is not ISDA's first protocol, but this definitely seems to be the most popular one it has ever done. As of 21st March, it had more than 13,500 adherents. So in all likelihood, most of your counterparties are out there and they have already adhered, but could be that they have not. And we'll go into it in the next slide, how you can change it for those counterparties. But if your counterparty has adhered to the protocol, when does your amendment become effective against those counterparties? And it all depends on the date. So if both parties have adhered to the protocol before the effective date of 25th of January, the amendments come into force on the 25th of January. But if either or both parties have adhered to the protocol after 25th of January, the effective date for these amendments for your counterparty would be the date the later of the two parties adhered. What this means is, suppose you have one party adhering on the 15th of February and the other party on the 25th of March, then it's the 25th of March which would be the effective date for the amendments for between these two parties. Now, what if your counterparty has not adhered to the protocol? Can you still adopt the protocol? There would be some parties who are reluctant to do it, maybe because of internal processes, or sometimes if you have a corporate on the other side, they might just have one trade and they may not want to enter into a protocol for just that one trade. So ISDA has thought about that eventuality as well, and it has come up with certain bilateral forms of amendment. And moreover, if you see the protocol, it covers a lot of situations and it has taken the market view for the largest participant group it could find. But there may be trades which are very peculiar or particular, and the protocol approach is not the right approach. And for those parties who have already adhered to the protocol, ISDA has come up with a form to take into account those particular trades. Now, ISDA has 3 amendment formats, and all of these 3 formats come in the both principal version and agency version. And the agency version is particularly important for the fund managers who manage multiple funds, and they may have multiple ISDAs for each of these funds. Now, going into these amendments in a little bit more detail, the first form of amendment is the short form amendment. It incorporates the ISDA IBOR fallbacks protocol by reference. And if you sign up to this bilateral short form amendment, it is exactly the same as signing up to the adhering to the protocol. You have made the exact same changes. It's very easy to do and very easy to manage as well. The other form is the long form amendment protocol. And here, ISDA has included the full text of the protocol into the format of the amendment. And crucially, it allows for certain amendments. Now, if you don't make these amendments, you might as well sign up to the short form. It's shorter and it gets you to the same position. But if you want to make certain amendments to the fallback regime, or if you want to make certain amendments, so if you want to delete certain old definitions under which you don't have any trades and you just don't want them in your agreements, you can do it through this long form amendment. The third is where both parties have adhered to the protocol, and accordingly, their protocol covered agreements have been updated with the new fallbacks. But for various reasons, it doesn't apply it shouldn't apply to those transactions or documents. For those cases, ISDA has a third form of amendment where you can pick out a different form of amendment for those particular trades. Notably, it reverses the changes made by the protocol. So it wasn't that it wasn't done, the changes were done, but now the changes are being reversed for particular documents. Now, what other supplemental wording is out there? So ISDA has three forms, but ISDA recognizes that there may be other permutations, combinations for trades between counterparties. So it has gone the extra step to actually come up with some template wording for other situations. These template wordings can be added to these form of the bilateral amendments or any other form of amendment that you may have. But these are not amendments on its own. So you can't just sign up to this language. You actually have to put it into the form of an amendment agreement. Now, the template wording it covers various situations. The first is if you have a hedged cash instrument and you need to follow the triggers and fallbacks to match the hedged cash instrument, you can do that with this language. You also have a language for documents which include the negotiated fallback. Just as an example, you may already have a transaction confirmation with the counterparty where you're moving from a USD LIBOR to a SOFR rate on the 1st of September 2020. Now, if you follow the fallbacks protocol, this is not the date this change is going to happen. So, and you've already negotiated this, so it's better to retain that. This can be accommodated through ISDA's language. And one of the others is if you have triggers and fallbacks identified in a different document. So suppose you have another domestic document where you already include the fallbacks, then you also have language to specify certain other trades under that. You can have various combinations of the above because these are all different situations. The fourth type of language that ISDA has is the 2020, to apply the 2020 IBOR fallbacks protocol to new trades where you don't incorporate the ISDA definitions or you don't incorporate the relevant IBOR the way it's defined in the ISDA definitions. So you can try to do that as well. And finally, and crucially, there is language to disapply the pre-cessation trigger. As Ahmad explained, that the pre-cessation trigger is where the regulator says before the end of cessation of LIBOR that the rates do not represent what is the underlying market. Now, under ARC's recommendations, this is an elective opt-in, but under the ISDA, this approach is hardwired for LIBOR into the fallbacks protocol. So if an announcement like that happens and the announcement is effective on a particular date, immediately your rate is switched to the adjusted RFR. Now, you may not want that to happen with respect to trades with your counterparties. You may want to continue to use LIBOR as long as it's available. And if that's the case, you can disapply this pre-cessation trigger by using ISDA suggested language. Now, this is more on the legacy trades, but what happens to the new trades? How exactly do you change the fallbacks for your new trades entered into after the effective date? So to address all of that, ISDA brought out a supplement to the 2006 ISDA definitions. Now, this is not the first supplement. It is actually the 70th supplement to the 2006 ISDA definitions. So you can imagine like 4 or 5 supplements come out each year. But of course, this is definitely the longest and from a market perspective, the most important change that this set of definitions have ever seen. The amendments and the fallbacks under the relevant IBORs have been completely amended and restated through this supplement to the IBOR fallbacks. And it applies to all new transactions entered into from the 25th of January 2021, which incorporates the 2006 ISDA definitions. And it applies to all legacy transactions, which incorporates the 2006 ISDA definitions, and both parties have adhered to the protocol or bilaterally adopted the protocol through an amendment agreement. Now, the way the fallbacks have changed is now for each rate specifically, there is a fallback waterfall. So the successive fallbacks rate. The primary fallback is on the occurrence of an index cessation event or a pre-cessation event where the rate is moving to an adjusted risk-free rate plus a credit adjustment spread. But when the 2006 ISDA was first, ISDA definitions were first drafted in 2006, Libor was very much there to stay. Nobody thought that Libor was a rate that could ever be discontinued, but the market has moved in such a way that we are at the point that Libor is being discontinued. So ISDA has ISDA and the market participants have thought about that what if any of these fallback rates also are discontinued in future, or they are not available? And accordingly, they have included further fallbacks, which includes following the Bloomberg rate adjustment rule book to actually calculate the rates yourself. And if those rates are not even not available through what is the data is available, it moves to certain rates that's already set out in the definitions. In particular, for the SONIA, it includes moves to a UK bank rate, and for USD SOFR, it moves to the FOMC rate. So notably, you can find your all-in rate in the relevant Bloomberg page. You don't actually have to calculate if you're following the IBOR fallbacks protocol. Now, what's the impact of the 5th March announcement by FCA? So the way index cessation event has been defined in the protocol, that announcement means that the index cessation event has occurred on 5th of March for all Libor rates. Currently, the index cessation effective date would be the 1st of January 2022 for most of the Libor rates, and 1st July 2023 for certain of the USD Libor rates. The spreads were fixed by Bloomberg as of the 5th of March 2021. So on the Bloomberg screen, you get the all-in rate, which includes the adjusted RFR plus the spread. The spread is a 5-year median rate between the historical differences between the IBOR and the relevant rates. And this was what was agreed to by the market. Another crucial point in FCA's announcement is the pre-cessation announcement. So they said that the pre-cessation announcement is not expected for any of these Libor settings. What that means for you is the switch to the fallback should only happen on the relevant date of 1st January 2022 or 1st July 2023. It should not happen before that. I will now move to the limitations of the protocol and what does it not do. The first obvious answer is the cash instrument linked swaps. So the borrowers and the hedge counterparties may have underlying loan linked or swap linked hedges where they have contractual obligations to follow another rate, or just commercially they might want to follow another rate. For those, you will need to engage bilaterally with your counterparty and make amendments to your contracts. Another aspect which is the market participants didn't consider is about the back-to-back hedge. This is very common in the regional market where you may have a loan-linked hedge with your borrower, but on the other side, you have a market hedge with the market counterparties because you don't want to house the hedge. Now, if the market hedge moves in the direction of the protocol and the borrower's hedge moves in the direction of the loan documents, you'll have a basis risk. It is important to understand and plug in this basis risk as well, partly from a document perspective and partly from a risk management perspective. The other big change that the protocol doesn't address is, of course, the Sharia compliant derivatives. The tahawut is excluded from the protocol. It's not included. Now, taking a step back, if you look at is the tahawut, its credit support deed, or the pre-printed forms of the undertakings, it doesn't actually refer to any IBOR, and the IBORs were included when you actually completed the undertakings for a particular transaction. And what this means is with the IBOR change, your transactions and transaction structure would be impacted. My colleague Ahmad has already spoken about the IFM initiative and the white paper, but the one important aspect from the derivative side is the white paper considered the feasibility of a protocol for Sharia compliant derivatives. And the first issue that was identified is the participant group and administrator may not be easily identified. So you don't know who your target audience, who the administrator would be, and that makes it difficult for a protocol to be managed. And the other thing for Sharia compliant derivatives is when the actual IBOR was included, it was included as a part of a structure, and changing the rate may not be sufficient. You might actually need to change the structure of the transaction that you entered into. But all of these will need to be done on a one-by-one agreement. So all your transactions will need to be amended one by one. And as such, there is no one-size-fits-all approach in the Sharia compliant derivatives world. The IFM has also spoken about coming up with recommendations also on the derivatives documents, but there is no timing indicated for that, and that makes it difficult to wait for such announcements to happen. Now, pulling it all together on the derivative side, what exactly should be your next steps? First of all, there is no substitute for due diligence. You just need to due diligence your transactions, both on the document side as well as the commercial side. On the document side, do you have any fallbacks already included? If not, what needs to be done? Can you take one of these approaches? Can you use another form? Or on the commercial side, do you have a cash instrument that is linked to some another trade or another bond, some loan? Do you have a back-to-back trade? How are you going to treat the back-to-back trade? What are your contractual obligations in respect of your loan link trade? Then coming on, what exactly do you need to do contractually? So first, I would recommend you sign up to the protocol. But even after you've signed up to the protocol, check whether your counterparties have signed up to the protocol. If your counterparties have signed up, do you have any trade that needs to be carved out from the protocol? If your certain counterparties have not adhered to the protocol, you need to bilaterally amend your transactions through a bilateral amendment. Identify your Sharia compliant documents and alternate structures. We can assist you with amending all of these documents as well as the due diligence for contractual sides for your legacy documents. For the new transactions, definitely always ensure that the 2006 ISDA definitions are incorporated into your new transactions. But that's not enough. You may have a new loan link trade where you need to update your ISDA and the confirmation to link to the new transaction. If that's the case, have you thought that? Should you be changing your templates? Should you be changing your ISDA? We can assist you with all of that. And finally, on the Sharia compliant trades, you have to be updating your structures and template documents. It's not enough to wait for the market response, because that might be too late. Particularly for the Sharia compliant banks, if you are now trading with the likes of JP Morgan, etc., who are subject to the Fed, JP Morgan, etc., will not be able to enter into any transactions with you unless you have a robust fallback. So you need to identify the fallbacks and update your template language right now. I will stop there and hand over to Natalia to moderate the questions.
Thank you, Madhurima. We've got 3 questions for you. The first is from Mustafa Barwan, and he just wants to clarify that the ISDA protocol covers the 2000 definitions as well.
It does.
Okay, thank you. The next question is from Ravi from ICICI Bank. And he said, what is the third form that was referred to in the slide when both parties have adhered to the protocol?
The third form is where you need to reverse the changes that's made by a protocol. So suppose you have 20 trades with one counterparty and only under one ISDA master agreement, and only one of them is linked to a loan. And for that particular loan, you should not be following the ISDA protocol. So you can reverse those changes made by the protocol by using the third form. It's also appropriate where you have multiple ISDAs with one counterparty, but only one of them is loan linked. So you need to carve that out of the protocol as well.
Okay, great, thank you. And then the last question is, consider fair value hedge bond, and one party is adhered to the protocol and the other party hasn't. It's an IRS, and 3-month Libor is used as a floater, and end date of the swap is 31st December 2022. Can both counterparties use Libor till the maturity?
If you have already entered into the transaction and given Libor, the 3-month Libor will be available till 30th of June 2023. It should be okay, but the new trades that you're entering into, you should clarify that the new version of the 2006 ISDA definitions are incorporated. So if you incorporate the 2006 ISDA definitions today, or any transaction or any time from the 25th of January 2025, the new version is already incorporated. So your new fallbacks are already in place. So you should be fine.
Thank you. And we've just got another question. To confirm, GMRA is covered under the ISDA protocol.
Yes, but you still need to check what changes you do need, because if the changes you need are not in accordance with what is required under the GMRA or what was your previous commercial agreement, you might need to take a relook. But the standard change is covered for a GMRA.
Thank you. So those are the only questions we had. So thank you for that.
Right. Thank you very much. If there are any other questions, then please feel free to get in touch with us, and we will get in touch with you with the response. We have put out a few updates for clients, and those are available on our website. We will be taking out more updates. If you'd like to have a further discussion on this, present to your wider group within your institution, we're happy to offer that. Natalia, is there anything else? Is there anything else come up? Or
yes, we've just got one question that's just come in. Will the new benchmark rate be applied effective 1st of January 2022, or will it be more preferable before this date?
Is that on the derivative side? So on the derivative side, the effective date would be the 1st of January 2022 for most of the Libor settings, except the ones that are going to continue to be issued till 30th of June 2023. For those, these are effective from the 1st of July 2023. Whether it's preferable or not is really a commercial issue, but it is important to follow where the market is going, and we would recommend that you follow the market unless you have other commercial considerations or contractual obligations. Ahmad, do you want to take it from the loan side as well?
Sure, of course. So from the loan side, there are a few perspectives. So you can right now, tomorrow, enter into a facility which is based on a new benchmark rate. For that, LMA has its exposure draft. You can have a facility now where you have a Libor or a SOFR link rate, which provides a rate switch mechanism. So for GBP Libor loans, on 31st December 2021, the rate switch will be effective. So the new RFRs will replace them.
Thank you for that.
all right. Thank you very much, everyone, and looking forward to staying in touch on this issue. And have a nice day. Thank you.
Thank you.
Thank you.
Thanks.